Let's check in right now on the markets. Our next guest says that despite the economic slowdown, the Fed has to shift its focus from tightening to accommodation. Let's bring in President and Chief Investment Officer at Hennion Walsh Asset Management, Kevin Mahn. Kevin, why do you think the Fed has to shift to lower rates sometime soon?
Becky, the long-awaited economic slowdown is finally coming to fruition as the current GDP now estimate from the Federal Reserve Bank of Atlanta shows GDP growth slowing to 1.2% in the fourth quarter from a revised total of 5.3% in the third quarter. We also know from the Federal Reserve's own projections, they're forecasting GDP growth of just 1.5% next year and growth staying below 2% all the way to 2026. As a result of that, the Fed is ultimately going to need to step in, lower interest rates as inflation continues to moderate. Once they lower interest rates, well, that's going to open up opportunities in stocks and bonds over the course of the next 2 to 3 years.
The Fed's not going to do that in December when they meet, and Jay Powell sounds not nearly as convinced as you are that those rate cuts have to come soon. What are you thinking? You think this needs to happen by March?
I'm looking at the end of the second quarter of 2024. We have to remember that the Fed has 3 tools in their arsenal to help combat record-setting levels of inflation. One is the Fed funds target rate, which they've now risen by 525 basis points since March of 2022. 2 is their balance sheet, which they continue to shrink to the tune of about $95 billion a month. The third tool that they have, Becky, is their rhetoric. And their rhetoric is running in full speed right now as they continue to suggest that they're going to remain data dependent and also keep rates higher for longer. The question is how much longer? I don't think they can go much past the second quarter of next year, or else they risk pushing this economic slowdown into a potential recessionary period.
The market gains we saw for the month of November, that makes sense if the Fed is more accommodative in that time frame?
Without a doubt. The rally that we saw in November is primarily due to the market's belief that we've now reached the end of this rate hike cycle. The next rally is going to come when the market starts to sniff that first rate cut. That may not come until the end of the second quarter of next year, which is a reminder to all investors not to try and time the market. We know trying to time the market is often an exercise futility. You need to be in the market and positioned appropriately so that you can take advantage of these rallies when they do take place. Once the Fed starts cutting rates, if you look at their last dot plot chart, Becky, they suggest nearly 300 basis points in rate cuts over the next 3 years. Well, then better days are indeed ahead for stocks and bonds.
So you don't think it's too late? Go ahead and just jump in.
I don't think it's too late whatsoever. In fact, we've done the research here at Smart Trust, and what we've seen is that there are 3 sectors that have historically performed best during periods of economic slowdowns, which are often accompanied by declining interest rates. Those sectors are consumer staples, healthcare, notably biotech, and industrials. One area we really like within industrials is aerospace and defense, particularly because defense spending in our country is forecasted to increase by nearly 50% over the next decade to $1.1 trillion. And those defense contractors will be the primary benefactors of that increase in defense spending.